You have the best strategy. You have the best risk management plan in place. You have indicators money can buy. You have wonderful setup most of the times. But why do you still lose? Most traders think that it is a strategy problem, but they don't know that it is actually a psychology problem. Emotions in trading are a hidden tax. Every time you buy, every time you sell, every time you get an entry, every time you overtrade, every time you are revenge trading, these are the tax you pay that are not refundable. These are the fees you pay that can never be refunded. So, welcome to another section of my emotional discipline, and I will be taking you through some little steps, some little things that can change your trading, results, that can give you better outcome. It might not give you a fast outcome, it might not give you the best, but I tell you, when you practice it, when you adapt some changes in your trading cycle, you should be able to battle with emotions and trade professionally. So this is why I have taken my time to make a video on emotional discipline in trading. So guys, stay tuned. Now let's look at the anatomy of emotional cycle. Then the first is the FOMO. In this diagram, you can see FOMO. It does start with FOMO, fear of missing out. Then you start looking for random trades. You start looking at trades that are not, that are not A+ setup. You start thinking that you have waited enough and you cannot be patient anymore. You cannot exercise more patience for a setup to play out. Then this thing starts disturbing you, FOMO. You start to experience the fear of missing out on a particular move. You start to assume that the market has moved in a direction that, okay, you can actually jump in. Then, but looking at your setup, it's not really realistic. That point you are looking at, that area, that your point of interest has not been matured yet. It's not matured yet. So, but you just feel like you should just jump on the trade because of your emotions. That's it, because of your emotions, fear of missing out. Then you give in to FOMO, you enter the trade. Then, before you know it, you start to experience euphoria. This is the point of your maximum risk, whereby you just know that, okay, all this trade I've taken, this is not what I'm supposed to have done. This is not the exact trade I'm supposed to have taken. This is not the right thing to do. But meanwhile, all your setup, all your trade is already running with the maximum risks you can take on that account. Let's say you have a $1,000 account, for instance, now, and your maximum risks per trade is, let's say per trade is maybe $100. Then you now even see yourself having, like, as at this point now, you know that the $100 is not even serving anymore. It's way above the maximum risks. Then you are maybe in like 50% or 70%. You are risking close to, as at that point of FOMO, you've added to trade, losing trade, you've added to your maybe winning trade. Then you just assume that it's not the A+ setup. You just want to leverage, you want to maximize profits, right? Then you are initially supposed to risk maybe 1%. As at this point now, you are risking 60% of your account. Then it now leads to that stage called euphoria, whereby you've gotten to a maximum point, right? This is the maximum point of risks you can take. Then what happens? Panic setting. You begin to panic, you begin to pray, God, please let this thing reverse, let this thing come back to my entry, let me just exit this trade. Most times, even when it comes back to your entry, your FOMO will still hold you back from exiting that trade. Your poor risk management will still keep you running in that trade. So you begin to panic. Most times you might not get that opportunity for you to come back. Then you begin to panic. Then what happened? Your trade hits stop loss. The only thing now is to start battling with depression, despair. Then it leads to that stage of despair. You'll be so devastated. Then you'll be so down. You can see the cycle. The cycle keeps playing over and over again. This emotional cycle is just there. It has been there before you were born. It is there right now, and it will be there after you are gone. So that's what you should just know. It's not a problem. It's not a problem at all. The fact that you've already known that there's an anatomy of emotional cycle, that from fear of missing out can lead to your maximum point of taking risks, can now also cause panic for you, which is not healthy. It's not healthy at all. Then those that are battling with panic attacks and those that are always panicking, you can see how their blood pressure is. Most times they're always battling with high blood pressure, and it's not healthy for you to be in that state regularly. All these things are not healthy. Then you now be depressed. then how do you want to battle a long period of being depressed every time? If you know that you have battled depression due to trading for a long period of time now, you can also indicate in the comment section. Let's talk about it. So you can see that you are spending time battling with depression. Then you end up blowing the account, you fund again after gathering yourself together, you fund again. Then you go back to the same emotional cycle. FOMO, euphoria, panic, and despair. That's just that for emotional cycle. When a trade goes against you, your brain doesn't see a fluctuation in your equity, but rather it sees a threat to your survival. Now your amygdala takes over, triggering a fight or flight response. This is where revenge trading, fight, or analysis paralysis, flight comes from. The three pillars of emotional discipline in trading are patience, detachment, and consistency. But it comes with its own problems. Patience comes with having to wait for trades for too long and taking a trade out of boredom and FOMO. Then detachment comes with tying your self-worth to the outcome of a trade. And the problem of consistency is changing the plan after one losing streak. You can see it's not actually easy. There's no, part of these problems. There's no part of these stages that doesn't have its own problems. Everything has its own problems. And also the discipline side of it are for the patience. You only trade when your A plus setup appears. Then for the detachment is you don't attach your wins or lose to your emotions. You only see it as a business. You don't see it as failure. You don't see it. You only see it as a loss. You don't see it as failure. Then for consistency, you trade even up to the next 20 to 40 setup the same way. That is where the discipline part of all these things come to play. You trade exactly the next 20 trade should be the same way you have traded the first, second trade. If you can do that, I bet you have mastered your emotions regarding all these three pillars. Look, think of yourself as a casino owner, not as a gambler. The casino owner doesn't celebrate every winning spin or cry over every jackpot, but they trust the math over 10,000 spins. Are you getting me? Now, this is an exercise for mental toughness. It's a 5 minute rule. If you feel the surge for anger over a losing trade, step away from the screen for at least 5 minutes. You cannot make a rational decision when your BP is above 100 BPM. You understand? When your heart rate is above 100 BPM, you cannot make any rational decision. So the best thing to do is for you to leave, your screen 5 minutes so that you can, come back to normal. Just leave it for 5 minutes. You can make any rational decision during that period. The next one is process-based journaling. Don't just journal your profit and loss. You should be able to journal if it's actually a good execution, if it's actually did you follow your step. Journal all that. Don't just journal profit and loss. Journal the process. Was it where all your rules, in check? Did you manage your trade well? Did you manage your risks well? All those things, journal it. So another thing again is for you to size down if you can't sleep because of your position. Your position is actually more than your emotional capital. So it's for you to step down your lot size, step down your trade, reduce your trade, or take your trades to break even so that you can have a good sleep. Once you have practiced all this, you will see that in the long run, your equity curve is, tilting towards the upside slowly in the long run. Then you reduce your drawdowns. So in the long run, your equity curves move upwards. Then your drawdowns become minimal. Emotional discipline isn't about feelings. It is about not acting on those feelings. So it is just the market taking money from impatient traders and giving it to patient traders. So in the long run, it's about not acting on those feelings, but rather being patient and also follow. It's more of a rule-based thing. It's more of consistent-based thing. Just follow your rules. Don't do anything based on emotions. Don't act based on it. Right? Don't act on it. It's about transferring money from those that are acting on it. It's transferring money onto those that are not acting on it. Just rule-based and following their rules. That's all. If this helped you shift your perspective, hit the like button and subscribe, and comment below what's the one emotions that ruined your trade in a very long period of time. What's that one emotion that always ruin your trades in a long period of time? Comment, I'll be there waiting for you. Thanks.